Hey there, and welcome to our channel. Today, we're going to delve into one of the most catastrophic financial crises in history, the Wall Street crash of 1929. The Roaring Twenties were a time of great prosperity and economic growth in the United States. The stock market was booming, and investors were making huge profits. However, this period of prosperity was built on a fragile foundation of speculation and excessive borrowing. In September 1929, the stock market reached its peak, and many investors began to sell their shares in anticipation of a market downturn. This selling frenzy, coupled with a wave of panic, led to a rapid decline in stock prices. On October 24, 1929, known as Black Thursday, the stock market experienced its first major crash, with millions of shares being sold in a single day. The panic continued throughout the following week, culminating in another major crash on October 29, 1929, known as Black Tuesday. The crash of 1929 was the start of a financial crisis that would devastate the American economy and have ripple effects throughout the world. The stock market lost over $30 billion in value, and many investors saw their fortunes disappear overnight. As the stock market crash triggered a wave of panic selling, many banks and financial institutions that had invested heavily in the market faced bankruptcy. As a result, people rushed to withdraw their savings, leading to a wave of bank failures and the loss of people's life savings. The economic downturn that followed the crash led to a sharp decline in consumer spending and investment, as people and businesses tightened their belts. Unemployment skyrocketed, and many businesses were forced to close, leading to a vicious cycle of economic contraction. The Wall Street crash of 1929 marked the beginning of the Great Depression, a period of economic hardship and social upheaval that would last for more than a decade. The effects of the crisis were felt not only in the United States but also around the world, as the crisis triggered a global economic downturn. In response to the crisis, the U.S. government implemented a range of policies and reforms aimed at stabilizing the financial system and promoting economic recovery. These included the creation of the Federal Reserve System, which was tasked with regulating the banking industry, and the establishment of new regulations and oversight of the stock market. Over time, the economy slowly recovered, thanks in part to the policies and reforms put in place after the crash. However, the Wall Street crash of 1929 left a lasting legacy, changing the way people thought about the stock market and the economy as a whole. Today, the lessons of the Wall Street crash of 1929 remain relevant, as the stock market continues to be a source of both wealth and risk. Understanding the factors that contributed to the crash, and the policies and reforms that were implemented in its aftermath, can help us to better understand the workings of the financial system and the risks involved in investing. Thank you for joining us today as we explored the history of the Wall Street crash of 1929. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more informative content.